are the best investing opportunities as we enter the dog days of summer? Here now is Dave Fondry, Portfolio Manager at Heartland Advisors, and Tom Lydon, President of Global Trends Investment. Gentlemen, thank you so much for joining us after the month of May and the way this month has started. A lot of people are just, ready to hide in the sidelines. What do you think? What's the best way to make money right now? Dave, what do you think?
Well, I think a bottoms-up fundamental approach has to work. It's a stock picker's market in my mind. Reasonably inexpensive for sure with this recent 16% correction. There's some bargains out there.
What makes you think it's not going to go down further?
Well, it could go down further, Melissa, but 16% correction, and is now trading, the S&P 500 is now trading for less than 13 times earnings. That's a very, very inexpensive market in my view. There has been a plethora of bad news. Nobody can predict the exact direction of the market. If you're a long-term investor and you can take some of the downside risks today, be rewarded in the future.
Tom, do you agree with that? I mean, do you think now is a good time to get in, or do you think if you've been on the sidelines, you might as well stay there for a little bit longer?
I think you should stay on the sidelines. Again, the long-term trends are down. You're below the major market 200-day averages in all indicators across the board. But there are a couple areas that are in uptrends, and one in particular, in junk bonds. If you look at junk bond ETF JNK, it's yielding over 10%. Junk bonds have become the investment vehicle of choice for those that are looking for yields. And in fact, they've continued to appreciate as those that are issuing junk bonds continue to do well as the economy recovers at a slow pace. The other area is gold. More and more central banks are buying gold. You can buy the granddaddy GLD that has over $53 billion in assets at this point. Or if you like the miners, there's GDX, which is the Van Eck Gold Miners ETF.
Tom, I mean, I said this at 1,000, that gold looked like it had run its course. And obviously I was dead wrong. But now we're at 1,200. How much further can it possibly go? I mean, would now be the time to get into gold if you weren't there?
Well, there are a lot of people that are talking about it, but the average investor still is just dipping their toe in the water. There are a lot of reasons from a safety standpoint. If central banks are continuing to pile up on gold, there's probably a good reason that it can move forward. But if you're feeling that gold might even stay and go flat at this period of time, the profitability is key with gold at these levels for the miners. It takes $275 to pull an ounce of gold out of the ground. Selling at $1,200, there's a huge profit margin there.
Dave, what do you think? Give me your best idea right now.
Well, I think JCI for the long term, that's Johnson Controls, they're playing an energy efficiency. If 70% of electricity in this country is burned in homes and buildings, they have a program to guarantee economic efficiency, and they guaranteed $4.6 billion worth of savings. I think it's a huge trend. The economic return is much quicker than if we put in solar installations or wind farms. So JCI, combine that with the #1 auto interior company in the world, and I think you've got a real fine company at 11, 12 times earnings.
Dave, give us another pick. What else do you like?
Well, Benchmark Electronics, I like it strictly on a valuation standpoint. If we're worried about the stock market going down, Benchmark is trading below book value. It's got $6 a share in cash. It's going to earn $1.25 this year, and it's a $15 stock. I don't know how you can go wrong. Plus, they have a reasonable expectation for growth over the next 2 years. 35% customer is now down less than 10%. That has muted their earnings and their growth over the last 3 years. They're past that. I'd say Benchmark Electronics is a good, safe play.
Tom, I liked your junk bond ETF idea. What's your time horizon like on that?
Well, look and stay in as long as it's above its 200-day average. Again, we saw a lot of volatility in junk and corporate high-yield bonds, but it's really stabilized this past year. And I think continuing profitability that we're going to see in these junk bond issuers will continue to bode well going forward.
Tom, you have one other idea, Claymore. Tell us about that.
Yeah, again, it's funny. The rich are sick of being frugal. There's money that's burning their hole in their pocket. And the Claymore Global Luxury ETF, Robb Report Index, is really doing quite well. So global luxury sales are up. They're bucking the trends. And I think through the demand through China and also the lower euro, we're going to continue to see profitability and higher prices in the global luxury side.
But how can you think that that's going to continue? I mean, we're looking at potentially a double dip in housing. Everybody's worried about the economy. We have higher taxes coming down the pike. I mean, if the wealthy have been outspending because they were tired of saving, you know, for a little while, maybe they feel satiated and they're going to go back into their shell now that we see some new uncertainty.
I think they've been in their shell and they're frustrated, and the rich are actually getting richer. Last year, there was a 17% increase in the U.S. alone in millionaires. So there's a whole segment of the marketplace that has money and actually have businesses that are doing well and want to spend.
Okay, what would you avoid right now? Dave, what would you avoid?
I think, well, in the very short term, I think that tech looks a little bit dicey. In the intermediate term, I like that area a lot.
Tom, what about you? What would you avoid right now?
Yeah, I think long-term treasuries. I think we had a great run up here. I can't imagine going any further. And then sticking with the dollar, avoiding the euro.
Okay, guys, we're going to leave it there. Thanks to both of you for joining us. Up next,
Thank you.
Last Chance.